Chapter 2, financial statements. The second part, we look at how to analyze the basic information that we learned about in financial statements, which is the balance sheet, the income statement, and the statement of cash flow. The one way to analyze it is to analyze, number one, how the firm has changed over time. And we call that a time series analysis. And then also we can compare the firm to other, and the key word is similar firms. And we call that a cross-sectional analysis. So either we can do a time series analysis or a cross-sectional analysis. And this is useful for several purposes. Sometimes as an internal manager, you want to know how the firm has changed or evolved over time. What are the things that are going well with the firm, and what are the shortcomings of the firm that need to be addressed? If you are a banker or a creditor, you want to know this information because you have provided loan to the firm, and you want to know whether the firm will have the ability to service that loan. If you are a shareholder, you may want to know that because there are many places you can invest in. The world of finance, one thing about the world of finance that is pretty obvious, that you have choices. You don't have to invest in any particular stock. You can choose whichever stock you want, but to make that choice, you have to know, how does this particular firm compare to the other choices you may have available? And you also may want to track it over time. If you have already invested in a firm, you want to find out how your investment is doing over time. So to perform this analysis, we group the different types of ratios that we can calculate into categories. And the first category we have is called profitability ratios. But just one word, why ratios? Just a quick word on that. Why ratios? Why not just look at the raw numbers themselves? The reason is that it is very difficult to compare firm A with firm B because their asset bases are so different. A small firm will have fewer assets than a large firm. And thus, the revenue of a small firm will be different than the revenue of a large firm. So if you have to compare between these two alternatives, how do you directly compare gross profit? A company making a $10 million profit on a $1 billion investment is not the same as another company making the same $10 million profit but on a $100 million investment. So to facilitate that kind of comparison, we calculate what are called ratios. So we standardize these numbers. For example, we are looking at gross margin. We already know what gross margin is, gross profit is. We take sales minus cost of goods sold. But now we take that gross profit as a percentage of sales. And that gives us a margin. So what percentage of sales was converted into gross profit? So how much did the company earn for each dollar of sales that it has generated? That gives us gross margin. Similarly, we can calculate operating margin. This time we take the gross profit, subtract other types of expenses. In essence, we get earnings before taxes, EBIT. Operating income is also EBIT, earnings before interest and taxes, and we divide that by sales. So for each dollar of sales, how much is my EBIT? Net profit margin, we go to the very bottom line, the net income line, and we take net income and we divide that by sales. So for the total profit that the company generated, what was the total profit for every unit of sales that the company had? So every dollar of sale that the company had. So now we can compare. Now we can compare a firm with $1 billion sales versus another firm with $100 million sales. Both may have the same $10 million income, but obviously their net profit margin will be vastly different from each other. And that will give us an indication of how profitable the company is. That's why we call these three groups of ratios profitability ratios. They're measuring profits at different stages within the income statement. Then we have a set of ratios that give us a measure of liquidity. Liquidity essentially indicates for us how much money does the company have to service its debt. So you can calculate current ratio. As you already know, net working capital is current assets minus current liabilities. What I'm doing over here, I'm taking that as a ratio, current assets over current liabilities. And I'm just calculating that. I can get a variation of that called quick ratio. In quick ratio, I get current assets, I subtract inventory. Why do I subtract inventory? Because inventory is the least liquid of the three items that make up current assets. If you recall, current assets is cash, accounts receivable, and inventory. Of them, this is the least liquid part. So I subtract that to get a better sense of both current ratio and current quick ratio. Essentially is telling us, do I have enough cash, enough liquidity on hand to service my short-term liabilities? Because what is current liability? Current liability generally is accounts payable and notes payable. These are the items that the company owes in 1 year or less. Does the company have enough liquidity on the top to service what it is, what it has, what it owes in 1 year or less? Cash ratio, just another variation of the same idea. I'm directly looking at, do I have enough cash holdings to service my current liabilities without having to worry about accounts receivable or inventory? So this is, of course, the most stringent of liquidity ratios. Then the next class of ratios we have are called asset efficiency. In these ratios, what we are trying to measure is to what extent we are effective in our utilization of assets. We don't invest in assets as a company just for the sake of investing, just for the sake of vanity. We invest in assets to drive sales, to generate income. So to what extent am I successful in that? So what is my asset turnover? How am I quickly converting my assets into sales, into revenue? And I can do different variations of that, compare sales to total assets, or I can compare sales to fixed assets, and that will give me fixed asset turnover. Then I get what are called a group of ratios that tell us my utilization of working capital. How long does it take for me to collect on my accounts receivable? Recall what accounts receivable are. These are things that we are owed. These are cash we are expecting to receive in the future. The question is, how long does it take us to receive that cash? So to calculate this, we take accounts receivable and we divide that by sales divided by 365. Because this is average daily sales. Average daily sales is total sales divided by 365. Inventory turnover. How long does it take us to turn over our inventory? In other words, convert inventory into sales, into sold goods. So we take the cost of goods sold, divide that into inventory. So it is essentially telling us how efficiently is the company turning over its inventory into sales, into revenue, into cash. So compute accounts payable, inventory days, and inventory turnover for 2013. And all you have to do is just apply those formulas. All you have to do is identify the relevant items on either the income statement and the balance sheet, or the balance sheet. So accounts payable is accounts payable divided by average daily cost of goods sold. Accounts payable is 29.2. Cost of goods sold is 153.4. I divide that by 365 is 69.48. Meaning on average it takes about 70 days to make goods on your accounts payable. On average it takes about 37 days or 36 days to convert inventory into sales. Okay. All right. So you can, similarly over here, accounts receivable days, it takes about 29 days to recover your accounts receivable, and it takes about 65 days for the inventory to be converted into sales. It takes about 90 days to make good on your payments. Okay. So inventory days would be inventory divided by cost of goods sold divided by 365. So this is average daily cost of goods sold, average daily cost of goods sold, average daily sales for accounts receivable. Okay. Then we have what are called interest coverage ratios. Interest coverage ratios is we take EBIT and we divide by interest, because interest is paid from what we have in EBIT. The more money we have in EBIT, the more flexibility we have for paying our interest. So over here, EBIT over interest is 1.54. That means I have almost 1.54 times the money I need to service my interest. And a variation of that, we do EBITDA. We do EBITDA because we know depreciation and amortization is a non-cash charge. So we take EBIT, add back the depreciation and amortization, and then divide it by 4.8. This gives me a better number. It tells me that I have 1.78 times the coverage I need to service my interest. Why is this important? Because if a company defaults on its interest payment, then they will be considered bankrupt. And bankruptcy implies that the company loses control of its management. A bankruptcy court now oversees how the company manages the company, how the company services which vendors first, which debt is met first, and all of that stuff, not to mention the enormous disruption it has on the company's operations. It undermines the confidence that suppliers and customers may have, and it may also scare off some of the best employees. So bankruptcy is not something that any company should take lightly, anybody should take lightly, and because it has profound implications on so many operating issues, but also on people's lives. And thus, it is important to monitor these ratios very carefully, that the company has enough coverage to meet their interest obligations. And you can also begin to see trends. For example, over here, the company's coverage went down. Slightly, but nonetheless, it's on a downward trajectory. If that downward trajectory becomes a trend, then that may present us with some problems. Okay, so that's interest coverage. And then finally, we have what are called leverage ratios. Leverage ratios indicate to us to what extent does the company have debt. Debt is a double-edged sword. We will not get into too much details in this course, but just a brief insight into debt. Debt is interesting because on one hand, when the company takes on debt, as we just saw in the income statement, the company can write off the interest payment. And by writing off the interest payment, it is reducing its tax liability. That's the good news. The bad news is that interest is obligatory, as we just covered. So if the firm is unable to service its interest, then the firm would be liable for bankruptcy. So this benefit of writing off interest against the cost of being obligated to pay interest has to be carefully evaluated. And thus many companies would, particularly shareholders and bondholders, would like to monitor to what extent is the firm financed by debt versus equity. Where is the company's financing coming from? Who is providing the capital? Which type of investors are providing capital to the firm? And we get what is called debt to equity ratios. We can also get debt to capital ratios. So now we are looking at debt as a percentage of both equity and debt. So as a percentage of the total capital. So it's the same idea. You can calculate net debt. You look at total debt, subtract excess cash and short-term investments out of it. So you can get net debt. But the more interesting ratios are debt to equity ratios and debt to capital ratios. We can also get debt to enterprise value. So different ways of looks, the same question is being answered. To what extent has the firm taken on debt because of the risk associated with debt? And then we have what are called multiplier ratios or PE ratios, where we look at the share price and divide that by earnings per share. The share price divided by earnings per share. Over here, we are looking at price over earnings. I will not get into the details of what this ratio means. I will reserve that when we get into the stock pricing chapter to discuss that a little bit more in details. But that's what we call the PE ratio. Just like we had interpreted the market to book ratio, if it is high, we had implied that's a growth firm. And if it is low, we had implied that it's a value firm. The same can be applied in the context of PE. High PE are growth firms, and low PE are value firms. Same idea. Okay. So we can look through some of these, you can work through some of these examples on how to calculate these ratios and these numbers, and also review some of the problem tutorials. The last thing we want is return on equity, probably the most important of all ratios, ROE. Why is it the most important? Because this readily tells us if the company is indeed attaining its objective. Its objective, remember, is shareholder wealth maximization. To what extent is it indeed providing the type of returns that equity holders are looking for? And how do we calculate that? We take net income, all of which belongs to the shareholders, and we divide that with what the shareholders had originally provided. That's why we take the book value of equity, not the market value, but the book value of equity. And that gives us the firm's return on investment to equity holders. Similarly, we can do return on assets, or what we call ROA, but the ROE is the more interesting of the numbers. Okay. All right. The last thing over here is called the DuPont identity. This is something that you're not responsible for. Don't worry about that. So we will stop over here. Right before DuPont identity is where we stop in the financial statement analysis chapter. And we are done with chapter 2.